Hi, everyone. This is Will. Hope you're having a great day today. So today we're just going to look at DTI or debt to income ratio. I am going to play a short video and have someone else that's better at explaining it than myself. And let's go ahead and get started.
If you're looking into buying a house, consumerfinance.gov can help you navigate the home buying process and understand any new financial terms you encounter along the way, like debt to income ratio or DTI. So, why does a debt to income ratio matter? Your DTI is all of your monthly debt obligations divided by your gross monthly income, which is the amount of money you earn before taxes and before any deductions are taken out. This percentage is one way lenders measure your ability to manage payments you make on money you borrow. It may affect how much a lender will loan to you, the interest it will charge, and what you feel comfortable spending on monthly mortgage payments as part of an overall budget. Different loan products have different DTI limits and lending criteria, and the same is true for different lenders. So it's important to look at all of your mortgage options and talk to multiple lenders to choose the loan that's right for you. ConsumerFinance.gov is your go-to resource for clear answers to hundreds of financial questions. To learn more about buying a house and choosing a mortgage, check out ConsumerFinance.gov/buying a house.
All right. Definitely think the consumer financing is definitely an opportunity to get more information in general. So you want to check that out at some point.
Public data are
Let me
important
stop this.
to help show whether lenders
Sorry
are
about
serving
that. All right, so get back to discussing DTI. So yes, when I started looking at velocity banking and DTI, I think I was above maybe 50 to 55%. Just ran some numbers on my credit report today on the credit report of me today, and I am about at 40.356. How did I get there? The first thing you want to do is they say take your gross income. So my gross income for the year from my W-2 job is 62,524.80. 62,524.80. This is my gross income for the year before. Gross income for the year, and then my monthly income, $6,410 monthly income. 6,410.40. And when I added up the bills on the credit report, came up with a total of $2,087 a month. That's the credit bills. Came up to $2,087 a month. That's just the bills. That's just the bills on the credit report. Rent, as I stated earlier, about 1,500. That's not included. That's on the credit report. But one of the things they pointed out is to include your rent. So these are my credit bills, and now I'm gonna add the rent, about 1,500. Let's see where I'm at. So they say take the total number of monthly expenses or monthly income, 6,410.40, and divided by the monthly bill. So this is my monthly income, and I'm going to divide it by the monthly bills and see what I come up with. Yeah, pull out a calculator. So monthly income, 6,410.40 divided by the bills together. This is the rent and the utilities, not the groceries, other bills, just what's on the credit report and rent and utilities. That's 7,853. Okay, divided by 3,587 divided by 3,587, and that gives 3,587 divided by 6,410 in general. So what I'm saying that the 1,500 of what I have could also be used for the debt to income ratio. So that's one of the things that I'm looking at, is trying to understand the debt to income ratio, or a DTI. And what I'm gonna do is look at that and see if it's been improved over the months by doing velocity banking. One of the additional things that I did, so last month, the HELOC itself was $49,141. The interest only that I'm paying just on the HELOC for that particular month, for the month of October, is $395. Now I'm only paying the interest only on the HELOC, so that's gonna bring it down just slightly, but it's gonna go right back up. It's just keeping it stable. Yesterday I did a cash advance from one of my favorite banks. I pulled off 1860 from the credit card, and I placed that onto the HELOC. Now, because that was a payment immediately, that brought the HELOC down, and I've also only just paid the interest. So 49,141 minus 1860, that'll bring me down to 47,281. Now that 47,281 is for yesterday and then today. So it's the average daily balance once they calculate it up, but also every day that this sits at this particular amount, the interest on it, as I stated before, is 0.1025. Now, when the HELOC was at $50,000, 500, I was paying $14.14 a day. So right now, I'm just going to average it out in general and just see. So 47,281 times 0.25 divided by 366 days out of the month. And I'm gonna just say 31 months. $47,281 divided by, or multiplied by 10 to 5 divided by 366 days, because we're in a leap year, and I'm gonna say 31 days. So that's $410 in interest right now on the 47,81. So on average, it's about $13 and I think 64 cents a day for the HELOC that I'm paying in interest. And right now I'm only paying the interest and nothing for the principal. The interest, the additional principal amount is going to pay down other debt, and it has gone down to pay other debt. Right now, happy to say I've gone from 12 credit cards. Last month, I had 3 credit cards left. Now I'm down to 2 credit cards with about $12,000 on them. So velocity banking has kind of worked so far. I don't know Some people may still consider it a scam and things of that nature. But for me, as I experiment with velocity banking as a political economist, I am not a financial planner. I'm not a CPA. I'm not an attorney. I'm a political economist. I look at the interactions between society and the economy. And when I came across velocity banking, I wanted to just start running some experiments because I didn't see anyone running experiments on the web about velocity banking. Also, in the previous videos, I talked about a documentary, so I hope to be the first one to document velocity banking from New York to Florida in general and see how other people are doing it and what's their understanding of it as I try to continue to explore and utilize velocity banking in general. One of the things that I ran into a couple of days ago with my particular HELOC, and this HELOC is an investor HELOC. I have multiple investment properties. So my HELOC is higher than normal. It's generally higher for, I think, investors versus those who have a primary home. So if I were to put this HELOC on a primary home, maybe I could have got it from 7 or 8%, but I got an investor HELOC. I got it at 25% of the value of the home. So that was I don't have, sorry about that. But that was 23.99% of the value of the home. So they gave me a $50,000 HELOC. I've been using that as my main operating account. And then I have credit cards on the side that I charge everything and I try to pay them off at the end of the month. However, since I've been running and putting things on them in general is much higher. I had to do some repairs, plumbing. I think I've spent maybe $3,500 on different types of repairs in the last few weeks within a 3 to 4 week period. But again, velocity banking has been good to me. And I've been doing this process probably since December of 2024. When I first started doing velocity banking, I was picking up my paycheck. From my paycheck, I was depositing into the bank. From the bank, I was paying my bills. Some of my bills included credit cards, loans, mortgages. I had 3 mortgages that I was paying on, but as a result of velocity banking, I was able to pay off. As a result of velocity banking, I was able to pay off 1 mortgage in less than a month. So I definitely hear individuals saying 3 to 5 years, but you can have it. It can be done in a month, and I did it off of my HELOC that they gave me 25%. So if they would have given me 80 to 90% of the HELOC, I think I would have been able to pay all 3 mortgages off in 1 month in general. So yeah, you can pay your mortgage off in 1 month in general if you have enough equity in your home to cover the mortgage. So then the money was going into the credit card, loans, mortgages, and then my other bills and expenses and some more debt. All right. So once I was able to consolidate some of that and I learned more, April of 2024, I was able to get a HELOC. So now I get my paycheck for my W-2 employment. It sits in the bank for a direct deposit. Soon as it hits the bank, I move it over to put everything I can into the HELOC. But I have 2 accounts that that is a monthly maintenance fee of $10 and $16. But in general, I try to move as much as I can into the home equity line of credit, and I operate out of there. So then I write my checks. And as I said, one of the challenges that I'm running into is that I hear on the internet, sometimes you can go in and out of your HELOC and pay the bills and things of that nature. For my particular HELOC, I have to pay the principal or the interest first before I can go in and out of the HELOC. Now, a couple of months ago, I was going in and out of the HELOC without that. I guess now they have their systems in place. They are set up now. So now I can have to make my principal payment every month first before I can start going in and out of the HELOC. Also, I only receive 5 checks at a time. So I have to keep ordering checks over a probably a 2-week period. So I'm trying to use different systems in terms of that. In terms of keeping this HELOC as low as possible, I have what's called offset accounts, and I'm using the last 2 remaining accounts. Last 2 credit cards are operating as my offset accounts. And an offset account allows me to make all the charges in 1 month. Then once my HELOC report to the credit bureau on the I think either the 28th through the 30th of each month, let that try to stay as low as I can by dumping in my income and other dollars that I come across. And then the next month, I go ahead and pay off as much as I can. But I think definitely the HELOC has been good for me. I'm down from 12 credit cards to approximately 2 credit cards. Just paid off another one about 2 days ago. So yeah, it's going good. If you have any questions, you have my number, my email, give me a call. You like to work with me and I can help strategize and work with you. Again, I was able to pay off one of my mortgages with a HELOC in well, I'm gonna say 2 months, but about a month. If I would have been able to get a principal HELOC in terms of if this was my home that I was living in, then I could have gotten probably $200,000. That would have wiped out all 3 of my mortgages, and then I would have had what's called an all-in-one mortgage. But I'm thankful that God has given me the opportunity to at least get this $50,000 HELOC that I have, and I'm working with it. So if you have any questions, any suggestions, any recommendations, please hit the like, subscribe button, share with other people, so that I can help other people to understand and for you to understand. If you have any questions, please just let me know. All right. Hope to see you in the documentary. Thank you. You have a great day.